Good afternoon, April 30th, 2019. Common sense from uncommon investors. And we have 5 of the world's greatest investors. And today, hopefully we'll get a little insight into why they have been, over the last 20 to 30 plus years, among the world's best investors. So I'd like to start, John, with you and talk a little bit about one of the things that you've really focused on is you've had uncommon rates of return for a long period of time. And part of your success is you've really focused on what you do well and not do what you might not do well. Tell us how you look at this 30-year track record of yours in private equity.
Sure. Well, we're having our conference tomorrow, and I pulled a couple of slides. So actually, if we could start with my slide 12, I think it is. And this will sort of give you some of the sense. But just to give you our track record, we've been doing this 30 years, Leonard Green and Partners. Over that period of time, we've raised 7 funds. Each one of those funds has or will return 2 times the money that was invested or better. We have about a 35% gross return, plus or minus, and after fees, et cetera. It's something in the 20s. And I think the point that I would sort of point to first is the last one, which is we earn our income from the deals that work, and we learn from the deals, we learn the business from the deals that don't work. So one of the great advantages that we have, and actually many of the panelists up here have, is we started at Drexel Burnham. And the great thing about working at Drexel Burnham, in addition to sort of learning about debt, was the rhythm. So the rhythm of the private equity industry is slow. If you've been in it for 5 or 6 years, you've done 2 or 3 deals, and you don't even know if they've worked. So the question is, how do you learn the business? Well, at Drexel, we were closing a deal a month. We were the financing. There were other folks who were doing the deals, but that rhythm essentially sort of showed us what worked and what didn't work. I think the thing that it's taught us is what our business is, and the most important is the first part, which is public markets date their investments. We marry our investments. And to give you an example of that, if you bought Barnes & Noble after the crash, you could have made some money on it for a period of time. Had we bought Barnes & Noble after the crash, we would have lost everything. So the rhythm of our investments are made over a long period of time. The advantages of being in the public market, there's lots of things to look at. They have 6,000 opportunities. We get to look at them one at a time. And the most important lessons that we've learned are the next point. What you buy is more important than the multiple you pay. I have never seen price make a bad deal a good deal, ever. And truthfully, I've never seen price make a good deal a bad deal. I've seen price make a good deal kind of a mediocre deal. But if all of the transactions we do either end up in the great or mediocre camp, we're going to do just fine. So that's why we've done as well as we can.
So, John, there's 1 or 2 more we just might touch on that list that you had up there. Mm-hmm. And one is there's no must-do deal. I know I used to tell the M&A department constantly where they got paid if you did a deal, have you ever seen a deal you didn't like? Okay? So if you are a customer or we're going to finance it, there's plenty of deals we don't like. And what do you mean by there's no deal, there's no must deal?
Well, again, that's sort of the benefits of experience over, we'll call say youth and energy. Young people want to get things done. And what happens is they end up target focused. You're in something and a little bit more starts to be okay. I've invested a year in this deal. I think I understand it well enough. Another 5% isn't going to hurt. And we get a lot of our younger people, this is the one you got to do. And what I've just sort of learned, no, it isn't the one. There'll be another deal. The key is avoiding making mistakes. And really that's kind of the point that that particular point addressed.
Now, Mitch, we've talked over the years about AI coming in. We've looked here at passive versus active management, markets and machines. And as you know, when I went to Wall Street, I could calculate yields in my head by going from base 10 to base 2, back to base 10. And then a machine appeared called a calculator, and that advantage was gone. Okay, I could remember, millions of trades, and then a machine appeared. It was the computer, and my advantage was gone. How do you see yourself competing markets machine going in the future?
So that's a key question. For value investors, when you're looking at low-cost index products, ETFs, you're dealing with machine learning, AI. What's the part of the market that a value investor that runs a hedge fund like we do and other kinds of products, how do we maintain a competitive advantage? But the first question I have to raise here for the audience is on slide 17. Can we bring that up? Right? So my question to you is, even with all the advances since Mike first entered the business, do you think by indicating applause, Mike can be replaced by a robot? Yes or no? No. Oh, okay. So why don't we give him a round of applause in the back there? The guy, maybe in 10 years you're going to program a robot to do the conference. But anyway, so if you bring up slide 17, this is the question. This is the question that we constantly face. And I think the answer
Mitch, I just want to know, is that your arm on the...
Yeah, I think it's Josh's. So, the issue really is, I think, going back to what we learned at Drexel many years ago, which is if you play the other guy's game and you have to just abide by the rules that are set by others and not recognize the manifold opportunities that the complex world keeps serving up, you're really not going to see the larger picture. So the issue really comes as to whether you can identify that part of the variegated landscape out there, the investment landscape, where you can occupy a competitive advantage, a niche. And so for us, what we say that in contrast to artificial intelligence, there is clearly a role for investors who pursue what I call artisanal intelligence. And we know that this exists in the world because the demand for craftsmanship, the demand for luxury goods, the demand for high value-added experiences exists in so many fields out there. And we see it, obviously, in the way products like the iPhone and others are designed not just because they're raw computing power, but because they have a design thinking element to that. They combine different things. They connect the dots across a broad spectrum of different elements so that you get a user experience that's amazing. So similarly, we have to look at the markets and say, okay, the amount of balance sheet capacity taken out of the system since 2008 in the financial world, the banks being restricted by Dodd-Frank and Basel and the Volcker Rule, means that there are so many gaps and cracks in the market. Obviously, you identified a huge gap and crack in the market, whether it's leveraged loans, high yield. Those are even more present today than ever before. Think about the amount of balance sheet capacity out of the system. That is one of the fundamental reasons that private capital, or the alternative finance market, is so able to play a role in today's world. So that's why firms like Apollo, Blackstone, BlackRock, et cetera, have done very well. We occupy, as Canyon, a smaller niche in applying not only a value investing approach, but an investment banking corporate finance framework, so that when we look at corporate debt securities, we look at structured products, we say, okay, how is that balance sheet going to evolve? What is it going to look like under different scenarios? Where in the secondary market are there no bids or proper bids for that particular security? What kind of security can we design to take out banks that no longer want to be part of that credit? How can we design a piece of paper that provides a return for our investors that's double digits and yet serves the company that needs to buy time so we can get its act together? So there are all those things which I'm sure other panelists, the other panelists here have dealt with in their own different product areas, et cetera, are all the opportunities that I think are still immune to the machines, the ETFs, the index products, et cetera, et cetera.
So Mitch, I think you know we've talked for 30 years plus about the concept that developing the right capital structure for a company, how to finance a company, you know, at the highest level is really an art. And whether it's being a chef, whether it's being an artist. And when many years ago when I started teaching classes, I would bring a portrait artist into the classroom in a graduate corporate finance course. And we would take one of the students, and the portrait artist would draw one line and eventually create a portrait. We gave an easel to every student. They were allowed to copy every line, and at the end they had a stick figure. And the point was, real talent you can't copy. Brian, let's talk about real talent here. You've been investing for 20 years, everyone else on this panel, 30. And you probably have the advantage that you came into a world where you were focused on computers increasing speed 1 million-fold, data transmission, etc. So you and your partner, Robert Smith, built the world's most successful private equity software firm. But you're competing today with firms that are generating enormous cash, that have values, in the case of Facebook, probably close to $20 million per employee. They can offer benefits and packages to anyone they want to recruit. So you're not building one company, you're building multiple companies. And if the CEO and the talent is so important, how have you built this organization over the last 20 so years?
Sure.
To attract the best and brightest to a private equity firm specializing in software?
That's a lot to unpack, Mike. Luckily, I brought no slides, so I have nothing to which to reference. I just want to go back to the topic that you guys were talking about before in terms of AI, machine learning. At Vista, we call it robotic process automation. But I think a lot of it has to do with how it's being used. You know, 20 years ago, if you had asked the same question to people about OCR technology, they would say, no, you don't understand. The way in which we input data is incredibly strategic because we can structure it as we input it. We can do all these things. Oracle, a company many of us have heard of, created this incredible relational database. And now all of that, for the most part, has been obviated by a lot of the new technological tools that have been created. So I would say that none of us should think that where AI is today is going to imply what we're going to see over the next 2, 3, or 5 years. And maybe with the notable exception of you, Mike, and certainly starting with me, since I only have 20 years of investing experience, I don't think any of us should be comfortable that ultimately machines can be programmed to do a lot of what we do. Today, for example, part of the way that we get around the race for talent is we use technology in many aspects of our due diligence. So we you talk about doing a deal a month. At Vista, we do a deal a month, and we do a lot of our due diligence is done with robotic process automation tools, going through contracts, evaluating different metrics that are important to us, evaluating how effective certain sales teams are, analyzing how they do relative to their comp plans, et cetera. All that is done by computers, so to speak, software. So I think one of the most important aspects for us at Vista in identifying talent is identifying who can work in this world where the lexicon has changed. Today, LinkedIn, as of February 2019, there are 22,000 open recs for tech companies for predictive analytics scientists. There's 13,000 for machine learning experts. There just aren't that many people around the world who know how to do this stuff. So it starts with training, to answer your question. So the first thing we do at Vista is we test everyone who comes across our table, and we have a very open funnel approach. You know, my partner and I didn't come from traditional private equity backgrounds. I can promise you that we have the least impressive resumes prior to starting Vista of everybody on this panel. But we had certain things that we were good at, and that we had certain rote capabilities that at the time people weren't really looking for. And so we've designed a series of tests to try and find other people, not necessarily just like us, because as everyone who's ever managed a team knows, you don't want to get a bunch of folks who look, act, and analyze just like you do, but really evaluate people based on the talent that they bring to the table. And we do it blindly, so we don't know when we look at test results whether someone is a man or a woman, what their name is, et cetera, and it gives us as much as we can as we analyze that data an unbiased view. When about 4% of the US population qualifies to kind of, after they take the test, to come and interview with us, the interviews we ask are very much situational and very much focused on the lexicon that we were just describing, which is how versant are you in this new world of technology, and how flexible are you in your thinking, because the one thing that Vista is going to bring every day to our companies is change. And after we evaluate that and we identify those people, and by the way, this isn't just for Vista, but at our 60 companies who employ 65,000 people, we then spend a great deal of money on training. Because as I mentioned earlier, frankly, we just don't have enough people around the world who understand how to create this great technology, manipulate it, and then use it in effective ways. That knowledge doesn't just reside in Seattle, in San Francisco, and Boston. Frankly, you find people who can be taught those things all around the world. And if you work really hard in training those people, you can end up with a very effective workforce. And that's how we do it at Vista.
Now, Brian, in terms of retaining and holding employees, so I remember many years ago when Bill Gates was the CEO of Microsoft, he hired a person who was probably going to be the CEO of what was the combined HP. And with his holdings, if this individual could increase the value of Microsoft, the value to him was so significant there was pretty much no price he couldn't pay if that person had talent. That individual eventually didn't work out. How do you retain, as you've built these successful software companies, how do you retain the leaders that you've brought and the investment you've made in people?
Well, thankfully, Robert and I don't have an approach, because Mrs. Sheth and Mrs. Smith need new shoes. But I think that you have to evaluate people for what they're going to do, both at the role and what they're going to bring to the organization. I think what's really important to understand about this next generation of people who are adding so much value today, this millennial generation, which is 2/3 of our workforce, is financial compensation is not always, and oftentimes not in the top 3 of their motivating factors for taking a job and staying at a job. The company or firm for which they work, what they do, how they represent in their communities, what their products do, how they change people's lives. These aren't taglines. These aren't things that they use for marketing propaganda. This is the stuff that they really care about. And so, at Vista, as you know, following your example, we've been kind of community and philanthropy first, and that really matters to the folks who work there. It matters a lot to the folks that work at the companies that we buy. And I think this, I'm very hopeful about this generation of millennials, that they're going to do really well by doing good. It's really important to them. But the reality is you've got to build an organization that can have a cost-effective workforce, but also creates the most value. And that goes back to what I said earlier, which is training. You can't expect that people are just going to figure it out on their own because they're very smart and they have certain tools. Tools in and of themselves, no matter how valuable they are ineffective without the context of application. And the only way young people understand that is through training and experience.
Steve, you've had over 30 years experience investing. I'm sure you've learned a lot of lessons over those years, and a lot of people go into the investment business for different reasons. Why did you go into the investment business, and maybe share some of these lessons over the last 30 years?
Sure. Mike, it's great to be back here. When I was 19, I knew I wanted to have a career in finance. In college, I passed my Series 7, my Series 63. I got spending money through trading, my bar mitzvah money. So it's from there I went to Wall Street investment bank training program. Then from there went to an asset manager, Mackay Shields. By the time I was 25, was given a $500 million portfolio to take over. The portfolio was I think 89 out of 91, and so the first thing I did, and this will actually figure in one of my lessons learned, was this fund was sold on a high dividend rate, on a above average dividend rate, yet triple C's were kind of a sucker's bet back then. So we lowered the dividend rate to the market rate. And I convinced management first thing out of the box to do that. The second thing was they used to buy what they thought was cheap, sell what was expensive, but didn't really have a process. So I developed a Graham-Dodd value liquidation type of analysis. And within 3 years, we were ranked the top fund and pretty much had that position until 2000. Took over the fund in June of 91. From there, I founded Golden Tree. And if you go to page 77, or slide 77, here are some of the lessons I've learned. First is, and there's a lot of lessons learned over the 30 years, and one of my favorite things is to keep learning. And the top lesson is great today is not great tomorrow. And you got to keep getting better. And it's hard to believe that 5 years from now, if we just stayed the same, no matter how good we are today, that would be competitive. I like John's slide being in the truth business. I think it's and not in the hope business. That, and to distill the difference between what you know, what's backed up by evidence, and what you hope, but that's not backed up by evidence. I talked before about when I took over the fund, I realized that we were at a structural disadvantage by promising a high dividend yield and how that wasn't a good neighborhood or platform to operate in. What I found over the years that having the right fund structure can really be a competitive advantage. Yep. So we have a slide which is slide 78, and give you an example with CLOs. So we've issued 14 CLOs from 2002 to 2016. And we've been, it's a product we're good at. We've in the top decile of. Returns have been good in the mid-teens. We've had about $1 billion of profits in this, over $1 billion in this product. But we saw that instead of doing deal by deal raising equity, if we did it in a fund form, that we could have a better product. And we could do that by warehousing more efficiently, by less for debt, by less cost of debt, by having greater scale. And as a result, we were able to improve our returns by 200 to 400 basis points. So we took something good and we made it better. The last lesson learned would be if you go back to 77, it's just not all yields are created equal, and that there's a hierarchy of yields. So when you're comparing opportunities, you want to compare what has the best catalyst, what has a tailwind opposed to a headwind. And if you have a headwind, that should rank at the bottom of the hierarchy. If you have a tailwind with a good catalyst at the top.
Thank you, Steve. Jonathan, I'd like to start with you in a different way than we've discussed. The world has changed, and when you think about what you wouldn't have invested in a decade ago, 2 decades ago, today, Jonathan, TPG is investing in biotech, it's investing in technology, things that probably would not have necessarily been the basis of a private equity firm. And let's take us back over the years and think about what you wouldn't have invested in before, what you're invested in today, why you've changed your mind as the CIO and made a change at TPG as to your investments today.
Great. Well, first I've got to start with, over the decades, I think we all value simplicity more and more. So my philosophy as a professional, as an investor, is simple judgments. And that started 33 years ago when I was coming out of college and I had the opportunity to work at places like Goldman and Morgan Stanley and Salomon Brothers. And then I met you, and I met John, and I met Mitch, and Kenny, and John Kissick, and Tony Ressler, and John Sokoloff, et cetera, et cetera, et cetera. And I made the simple judgment that these are the people that I want to learn from. And that was the start of my career 33 years ago here. And I got very lucky a few years later to do the same thing with David Bonderman and Jim Coulter, and I've had 27 years learning from them.
So the point of that is you're much younger than we are. So.
I'm only 9 years younger than you, but you're a lot more handsome and in better shape than me. One of the most important things that I realize, having been in this business for 33 years, is that we are all very, very lucky. We have all lived through the greatest anomaly in asset value pricing ever. So as good as investors as we all might be, there has never been a time that interest rates have gone from 12% to 2%, and that has been a tailwind that has helped us all. That is now pretty much over. Maybe rates stay low, maybe they go up at some point over the next 5 or 10 years, but they are not going to go down from here at the rate that they went down over the last 35 years. So as a result of that, I've got to think about a couple things. Number one, I have to try to find inflections. So this is a chart of unemployment, and it's absolutely amazing that you can have unemployment go from whatever its peak level is on a straight line down, and then one day or 1 month or 1 quarter, it turns and goes completely the other way. So I'm always trying to think about when we're in an environment like we're in today, where everyone is complacent and everyone thinks that this 10-year cycle will become a 15 or 20-year cycle, I'm trying to think about where I'm going to see inflections. And today the inflections are mostly driven by disruption, they're driven by technology, they're driven by demographic and social changes, and they're driven by science and medical changes. So to your question, what are we investing in today at TPG in year 27 that we wouldn't even have thought of 27 years ago? Last week we made a $250 million investment in a brand new seed round of a gene therapy company. A few years ago, 7 years ago, we invested in the B round of Uber. We would have never done that 27 years ago. It's been about trying to find big disruptions with business models that have true competitive differentiation, that have true network effects in very large markets, and trying to get behind that. Invest in secular growth, particularly at a time when we're late in the cycle, and we know that most businesses will have the problem of a cycle turning over and being cyclical in some sense. Every business is cyclical in some sense, but those that can power their way through it through secular growth in healthcare, in technology, in internet-enabled businesses, in science. And you have to have real expertise to try to find those. So we're going very, very deep in terms of real expertise. The other thing is we're in a world where more and more of the investors in our profession, they all speak relative value as opposed to absolute value. At the end of the day, everything's net present value. And the net present value can be higher because of super low interest rates. But most of what people talk about when I'm talking to them is, of course we can pay 18 times EBITDA for this company because their comps are trading at 17 or 19 or 18. But they've never actually done the work to understand that the absolute value might be 12 times when we used to think it was 10 or 9 times, but it's not 18 times. So really investing in absolute value, not relative value. And then the only thing that I've seen that is maybe a bit contrarian is every once in a while we're finding a company where their business model advantage, and this is kind of weird to say, but is that they're willing to lose more money than anyone else for a while. Now, that's a very dangerous thing, but we have an example in Amazon. We have an example, perhaps, in Uber, that will be a $100 billion company being willing to lose more money than anyone else. Now, that's really scary, but in some circumstances, this is the one situation where I could say, I would have never thought about that as something that I could get behind. But if you have the wherewithal to weather that storm, as Amazon has, as Uber has, that's the one place that I might invest differently today, in addition to real science, real technology, real disruption, and real growth.
Thank you. Now I'm going to go to short answers this time. 3 of the people on the panel have taken in outside investors. Everyone on the panel is a private company. 2 of the people on the panel, 100% is owned internally. So let's start with yourself, John. You sold a piece of the company. Has it changed the way you operate the company at all?
I'd say in sort of subtle ways, having a partner creates a sense of urgency, responsibility. We have a wonderful business. It's been extraordinarily fruitful and beneficial for the partners there. Taking in a new outside partner that that came in with expectations as to return. While it's not contractual, they are our partners. They have expectations, and we've made promises to them, and we expect to keep them. So what it's caused us to do is to rethink, in some cases restaff, start new businesses, those sorts of things. So it's add a sense of urgency as it relates to that, and then also as it relates to sort of planning for the next generation.
All right, Brian.
Yeah, I think it's generally been a good thing. I think if you ask the other folks at Vista, it's been a great thing, because before we took on outside investors, all the ownership was held by Robert and myself. So they've enjoyed it even more than we have. I think it's to echo some of John's thoughts. When you have founders that run a company, and whether it's software companies or private equity firms, oftentimes you don't know what you don't know. And so I think bringing in a perspective from people who do it for a living, who've seen a variety of different business models within the industry in which you operate, unless you're a really bad listener, it should bring some good new stuff to the table. And I think the last piece, at least in Vista's case, and maybe we're unique above here amongst the group here, it brought a level of professionalism, not the way that we dealt with our portfolio companies or our investors, but frankly, the way that we dealt with each other. Robert and I, our investor meetings were at each other's houses. We would talk about stuff over coffee, we'd talk about stuff over lunch or dinner or drinks. Strike that last piece. And when you bring on an outside investor, you have to be more prepared, you have to be more disciplined, you have to convey things in ways in which they understand, and they obviously didn't grow up from the beginning at Vista in 2000, and so I think that just makes you better.
Steve, you haven't taken outside partners. I'm assuming 100% is owned by the people that work for the firm.
Yes, so
I'm sure you've had many opportunities. You've been approached numerous times. What has been your philosophy?
So our philosophy first is we have 28 partners, and about 60% of our partners didn't start off as partners but became partners. Homegrown, and the idea that you can come to Golden Tree, can be a partner, can share in the growth of the firm is something that we find has been a competitive advantage. I see employee number, I think 3 in the who started off as a trading assistant and now is leading our business development office. Is one of the partners here, and it's really So that's a competitive advantage. In terms of, for us, it's been, we're not against the other model. It's just not necessarily something that we've been thinking about.
Mitch, you have kind of a partnership like Brian has with Robert, with Josh. What have you thought about in this?
Yeah, 40 years. Josh and I met. We were in the same section at Harvard Business School. We were in the joint law and business program there. We met in September of 1978. And then Josh asked me, after we survived the first year of business school, whether we could take an apartment on Soldiers Field Park. And so we did that, and we didn't kill each other after 2 years. And then, as you know, Mike, and some of the other guys from the Drexel days, Josh was, while I was doing distressed in your shop, I joined in November '83. Josh was in the M&A department at Goldman, and Peter Ackerman had this burgeoning business called leveraged buyouts and highly confident letters. And he said one late night that he needed some additional help. So I said, Josh might, I know, very low probability, leave Goldman. Nobody left Goldman in those days. So he came out, interviewed with you and Peter and some of the other guys, and saw what you were referring to, Jonathan, before, about the fact that there was an opportunity to learn like no other. He joined in August '84. So the two of us working at Drexel did, as Josh says, everything from leveraged buyouts to leveraged die-outs. In other words, all forms of balance sheet change. And since that time, the evolution of Canyon in terms of a partnership structure, I think, is somewhat similar to what Steve was saying at his firm. We have about 13 partners, and we have 240 plus employees in different offices around the world. And we have designed a system where the partners and another tier of our colleagues share in the incentive fee. And this is an evolving thing because demography is, is inevitable, and we're all getting to the point where, I think, as Josh says, our colleagues at Canyon look at us and wonder how long we're going to continue at this game. You're younger, Steve, so I don't think.
Well, I still see you as 30 years old.
Yeah, you're
so
right.
It's the same to me.
Yeah.
Jonathan, you have had outside investors longer than anyone here by far. What has that experience been from TPG?
Well, early on, when first Blackstone went public and then KKR and then Apollo, et cetera, we thought about the pluses and minuses of being a public company. And we made a decision that we wanted to see whether there was any real competitive advantage that came from being a public company. We really liked being private. So we decided that we're going to just stay private until we believe that there was some competitive disadvantage to being private. We did take in private capital from two very large sovereign wealth funds. We've sold about 10-ish% of the firm over the last 10 years to those. It's been relatively innocuous, except that it's made us think more about who we have a responsibility for in terms of growing the organization from what was a partnership of 4 people originally to now a 1,000-person firm. And we know that first and foremost, our duty and our service is to our limited partners. Our product is great returns. Our product is great returns for the retirees and the beneficiaries. That's our primary duty. Another duty is to our employees and to our professionals. And now we have a duty to these couple of institutions that are 10% owners. And what it's meant for us is we've tried to think about when we're all in a different part of our lives and careers, how do we evolve this organization in a way that it can be around 25 years from now. My hats are off to Blackstone and KKR and Apollo and Oaktree and others who found a way to institutionalize what is a human capital business. but we've been really trying to think about how the firm can be around and a force 25, 30 years from now. And that's been more solidified by the fact that we have a duty to these outside investors. We have 80 individual partners in our firm that share in the equity of the firm, and now there's 80 shareholders in addition to those institutions.
So, Mike, I just wanted to add one other thing, and I think it also speaks to Steve's experience, that when you don't have an outside, outside capital, there is a simplicity in terms of your interests with investors, because Josh and I and our colleagues are the largest investors in our hedge fund product, and when we start a new product, whether it's a CLO equity fund or some of the real estate senior mezzanine loan funds that we've started that you know about, or our new deal with AECOM, an equity real estate oriented fund. The issue is, okay, how much capital are you going to be putting up? How much capital are you, Josh, our colleagues? So the simplicity of it and the congruence between your interests and investors is shown not only by the amount of time and energy that you put into managing the different portfolios, but also the amount of capital, financial capital, that you're committed. And that alignment is very simple, but it also means that your ability to evolve over time is a function of the firm's profitability and plowing it back into the firm.
So, Brian, I want to go to you. We've heard about these different models, valuations. So Microsoft is the largest software firm in the world. Oracle's the second, SAP is the third, and the company's Vista is the fourth largest software firm in the world. You've got market valuations on companies that are smaller than you of $135 billion. In the case of Salesforce or other companies.
So you're saying Dow got a great deal.
Well, your investors have a good deal, but obviously, what is the ideal structure? In other words, right now you're in a traditional private equity structure where valuations of the software companies you hold today in the market cap of them, and I'm sure you're monitoring them, are so much higher theoretically than your portfolio is today.
Yeah.
What would you say the value of all your portfolios companies are today if you had to think about it relative to what the value might be if they were one company?
Yeah, no, I think it's a great question, and it's one that's really important because for Vista, maybe uniquely amongst private equity firms, we operate as one company. Because we only do one thing. We try to echo somebody's point earlier, we try to make it very simple. So we just buy enterprise software companies, and then after we buy them, we run them collaboratively across a shared platform. And part of what I think makes it so effective is so many of our founders who come from whom we buy their companies continue and stay with us because they get to be trained by one another, by the people who have been part of this platform for a long time. I call it YPO or Vistage for software, in deference to you, Mike. You know, there's no question that we would create more value if we brought the companies together and took it public. The question becomes, how does that affect your ability to become nimble? I didn't exactly agree with what Mitch had to say about being maybe more flexible or more committed if it's all your own capital. I do think capital structure can affect your ability to adapt to change. And I think it's tremendously important to be able to do that. And one of the things that we evaluate when we think about whether or not we want to merge some of our businesses together and sell them off like we did last year with a company called PowerSchool, or keep them individually like we have with our cybersecurity companies and let them flourish independently, is thinking about where they are relative to their competitors. So while our business is very simple, we buy and sell ones and zeros, it gets a little bit more complicated when you consider the context of those ones and zeros. So when you're selling cybersecurity, for example, it's very important for your customers to know that you can adapt to any outside threat and you're not beholden to certain platforms. When you're selling something which is a little bit less complex, like enterprise software or front office software to a specific vertical, your customers may actually prefer that you merge the different investments that you've made together because it gives them one less throat to choke. One of the amazing things about software is there's over 100,000 independent software vendors out there in the world. And many of you who represent large companies, you would be surprised to know that you have over 1,000 individual software vendors who sell to you. And that sounds ridiculous. You don't have that many furniture vendors or, you know, I don't know, all the things that these guys invest in who sell to your companies do. You have one, you have two, maybe three. We have, depending on how big you are, probably 15 or 20 of our companies that sell software to you. And the reason why is software is the most productive tool introduced in the Western economy in the last 40 years, and it's only getting more productive. So we have to balance kind of the short to intermediate financial benefit of combining these companies together for one set of stakeholders, which is our investors, with the second perspective, which sometimes has to be paramount, which is how nimble and how creative can these companies remain and how relevant to their customer bases they continue to wage combat against their competitors and try the very difficult task of remaining a relevant technology company. So that's how we think about it. But I think the trend of software companies getting bigger, you know, nobody's going to fight that. You look at Adobe, not just the big companies that you mentioned, but the great companies that kind of are smaller than us in size, but are growing and very successful. Adobe, Salesforce, ServiceNow, as just some examples. They are all tremendously acquisitive. And depending on the company, they've all been, have mixed track record of success in those acquisitions. But the key for them has been, can they continue to be relevant for their customer base? Can they continue to attract a great talent base so they can build better products in the future? And are they being successful for all of their stakeholders? That's how we think about it.
So Steve, I want to go to you. You, when I look back over the years, take on the most complicated, difficult situations. You've got governments involved, you have provinces involved, you've got, you know, tens of billions of debt in these companies. There's 7 different levels, which on the cover of it, most people say, I'm not going there. For some reason, the more complicated it is, the more exciting it is for you, and I know you feel you have an additive rate of return. Let's take 2 things, Puerto Rico and Frontier. Okay? Sure. Talk to us about those 2. Why have you been focused on these, and what do you see that others didn't see?
So, you know, on both those on situations, I always look for actually the simple. I always try and think of what the simplest answer is going to be.
Well, the simple is Treasury bills at 2.3 or wherever they are, 2.2. Well, that's the simple.
So, you know, if you look at Puerto Rico, right after Maria, it was trading at 19% of GNP. If you looked up the New York Fed right before Maria, suggested that they could be able to support 60% of GNP. There's 20 boxes. So if you pick a good box, and then you're at such a discount, it didn't seem that hard. So we felt like that was one part of the investment where we didn't think the degree of difficulty was all that complicated. Probably what I thought was even easier was after both sides agreed and the transition, and this is on slide 73, and in this type of market where valuations compared to last December currently now are certainly in the top quartile or near there, is when both sides agreed and looking at the transition of the COFINA debt from debt holders, from distressed holders to municipal bond investors, that was, to me, really kind of a simple trade. In fact, we were much more excited about that investment after both sides agreed than in the beginning when it was unclear what the money from the Treasury would be, what it would be junior, senior, et cetera. So we look actually for simple high margin of safety, which would be that 19% versus 60% in terms of debt to GNP. And then when we think that there's a good margin of safety of where the back end of something would trade, you know, for instance, comparing COFINA, which is tax-tied revenue bonds, and comparing it to other tax-tied revenue bonds. For instance, it's a sales tax bond in Puerto Rico versus Chicago. In the case of something like Frontier, it's the same thing. If you look at Windstream, was a situation which structurally is very inefficient. They basically did a REIT of some of their assets that basically makes the remaining company very inefficient and very capital intensive. But when you looked at the most senior part of that capital structure, as soon as they were structured, traded up from 90 to par, and if you include interest, about 15%, and it was clear that you were worth 100 cents. In something like Frontier, that exists currently where you have operating debt. It's a very involved capital structure with lots of different levels. But if you look at the OpCo that we think loan to value might be 10%, you're getting, we think, a situation where you're likely to get a 15% return if they restructure. And if they don't restructure, that's good because it means that they were able to grow out of it. So we try and look for what we think is the most simple solution in a very complicated problem.
Well, you know, once again, when you put the energy in and structure, to you it's simple, to others, why bother? and I think that is one of the areas and why the title of this panel is really common sense from uncommon investors. There is no easy way to look at Puerto Rico. There's too many factors, too many levels. There's no easy way to look at Frontier, but you've spent 30 years doing these things, and so this is the concept of risk. Risk is a perception, basically, of how you're looking at the world from that standpoint. So there's all these little measurements that come out and pop out that I thought were interesting. So in the private equity industry, I thought this Dunning-Kruger effect, okay? The Dunning-Kruger effect. Can you tell us what that is, John?
Well, it's the Dunning-Kruger effect is it's sort of analogous to the learning curve. But basically, what it measures is your degree of confidence in something with the amount of time you spend studying whatever it is. And I put this is a little bit tongue-in-cheek, but basically this is what effect is the diagram of the decision-making associated with an auctioned company. So it's interesting, I sort of hear this and I hear the value of simplicity, and then I listen to Puerto Rico bonds or whatever they were and whatever they went to, and it's not simple anyway. But I take a look at this. Anyway, this is sort of fun. What it sort of says is a company is offered for sale. It's presented to folks in our industry. We have about 100 days to do our due diligence, and then we have to make a decision. And we make the decision at the top of, according to Dunning-Kruger, Mount Stupid. So that's when we make the decision whether to make an investment. Okay, we've bought it, and what our industry does is we implement our 100-day plan. We figure, okay, this is actually what we really own, and then for the next year or two, we hope it works out. And that's simple. That's sort of simple. I think our advantage is, if you're aware of just the tensions and such here, it sort of helps you make better decisions. So what we like to think is, while we may be making the decision at the top of Mount Stupid, at least we understand that, and so maybe we're a little lower on Mount Stupid, or Mount Stupid's a little lower. But the other sort of realization that we've had is, so our 100-day plan, once we own something, is to listen, because we know about 80% of what we need to know when we have to make an investment decision. And then after that, we can put in our next 100-day plan, which is to listen. And then after that, we can put in our next 100-day plan, which is to listen. And about a year after we know it, we probably know enough to start shaping the direction of the business. It's a very different approach than many others in our business have. And I think probably and it sort of sounds a little silly, but it's sort of having the humility to understand what it is you don't know, and having the willingness, the recognition of what you don't know, the willingness to wait before you take actions. That steers you very well, and that's sort of why we've done as well as we've had. And again, what I would sort of suggest is, again, our model is we buy the best companies. We do pay the high prices, but we figure if we own it over 5 or 6 years, we pay a little too much. That's okay. It is, of all of the strategies up here, 1,000 people in an office, I don't even understand what these guys are saying. Certainly figuring out what the
That's why you're not in the credit business.
right. And certainly trying to figure out where technology is going, which you guys do better than anybody. For us, we own car washes, and car washes have been great for us. We've invested $250 million. We've made a couple $1 billion on that transaction, and it was just sort of riding a trend, listening, having a great manager, hanging in there. So I think Warren Buffett said it best. He said, investing is easy. It's not simple, but it's easy. So we basically just make it as easy as we can for ourselves.
So in closing, I really want to go down the panel and really focus on investment time. I think John Danhakl pointed out that there are investments that go up and down, and depending on your ability, where you're in the cycle, you can make a great deal of money.
Yeah.
But for you, you hold them long. Steve, how long is your average holding, would you say?
So we have a variety of strategies. So in our distressed private equity business, it's a few years. In our long-short credit fund, it's usually about 12 months.
Brian?
Yeah, it's shrinking. It used to be 4.7 years, and then we're currently at about 3.3. But I think that has a lot to do with where we are in the cycle.
Mitch?
I am, along with Steve, there's two things that drive duration in these funds. Number one, the structure and the degree of complexity of what you're buying. I mean, if there's anything to be taken away from today's panel, it's structure determines behavior and performance, number one. And we all, in different ways, buy complexity and we sell simplicity. So in keeping with those two basic ideas, hedge fund, yes, is average a year to a year and a half. The locked up funds that we have where we're doing distressed or we focus on securitizations, that could be 2 years because it's more consistent with the longer duration element. If we're doing real estate, it's usually the length of the lending and mezzanine. It's the length of those senior loans and mezzanine. And if it's going to be an equity deal like the AECOM deal, it's going to be something longer, 4 or 5 years. And then finally, if you do a CLO equity fund, the reinvestment, while the duration is somewhat short because you're getting so much cash back from that waterfall structure, it could last over a 10-year period.
Thank you, Mitch. John?
So I'd say on average 4 to 5 years, but I think one of the lessons we've learned, again, over 30 years is hold your winners. So some of our best companies we've owned for decades. One story, we bought a company called Leslie's Pool Mart. We bought it in 1997. We paid $140 million for it. We invested $15 million. Over 20 years, that $15 million turned into $1.5 billion. Just owning that, moving it from fund to fund, and continuing to sort of own it. So the good ones we own as long as we can.
Yeah, same. Our average period over 25 years has been a little over 5.5 years. John and I did a deal that's now in its 16th year. IQVIA, the combination of Quintiles and IMS, it's a 30-bagger. And it's basically a failure if we hold a company so short that we can't continue to compound at very high rates of return on that.
So I think one of the challenges we see as we talk to institutional investors is many of them don't want their money back today. And so they want you to reinvest it, Mitch. They want you to reinvest it, Steve. They cannot compound their money at the rate that you're compounding the money for them. And so I think this is a challenge. But I think what we saw here is common sense from uncommon investors, and things that might appear complicated to others don't appear complicated to them because of their experience. And the last point I think we saw today is sticking with what you know best serves you in the long term to generate superior rate of return. So thank you very much for joining us.
Mike.
Thank you, Mike.